Hello everyone. Today we'll talk about what is mutual fund, what are the problems in investing in stocks, and why prefer mutual fund. First things first, what is mutual fund? Mutual fund is a scheme that contains stocks, bonds, short-term money market instruments, and other securities. We'll invest our money in these schemes for better returns. Why? Because these schemes are professionally managed by fund managers who are typically MBA, finance, or CA guy. They will take care of our money and invest in stocks, bonds, and other securities. You will be able to understand the concept of mutual fund when you understand what are the problems in investing in stocks. We'll move on to the next slide. So, what are the problems? When you want to invest your stocks, you see what is the company, how is the company's performance. Every quarter, company shows result. You will see if the company's profit is higher than the previous quarter or compare it with the last year quarter. You will check what is the future prospects of the company. You will see which business one has to invest in or see which businesses are good for the next 10 years. Say, for example, media stocks. Few media stocks have gone down because of OTT like Netflix, Amazon. So you will have to analyze about that. There can be some old stocks, government stocks like SAIL, GAIL, or you may have to think about investing in solar units or electric vehicles, as these could be thought of as good business for the next 10 years. So there's a lot of analysis, and this is time consuming. Also, you need to check uh, what is the promoter, is he ethical or not, is he maintaining accounts properly, or does he misinterpret the accounts, or do they show the profit higher than the actual. Not many might know how to track them. Say, for example, you want to invest in a pharmaceutical company and assume there are 20 companies. You don't know which company is good or bad, not sure how they prepare the medicine, can't even analyze. Then opt for mutual fund. So, as explained before in the previous slide, mutual funds are managed professionally by the fund manager. Instead of picking one stock, they pick 20 to 25 stocks based on their research acumen, stock picking skills, and maintain a portfolio. That is a list of stocks. So, say example, in one mutual fund they have 20 shares, then you invest 20 rupees, then 1 rupee goes into all the shares, 40 rupees, then 2 rupees goes into all the shares, 60 rupees, then 3 rupees goes into all the shares. But the minimum investment for the mutual fund starts with 500 rupees. Yes. So when you want to invest in mutual fund, there are two things that you need to look at. One is CAGR and expense ratio. CAGR is compound annual growth rate. I'll explain. So this shows the constant rate of return within the time period. Say example, you want to invest 100 rupees and you have invested in it, and there is a 10% profit in the first year. So 10% of 100 would be 10, so 100 plus 10, 110 rupees in the first year. Second year, there is again a 10% profit. Then you will have 110 rupees, 10% of 110 will be 11. So 110 plus 11 would be 121 rupees. So if I say CAGR is 10% for the last 2 years, it means there is 10% of increase every year. Yeah. Let's take another scenario. You invest 100 rupees and there is a profit of 25% in the first year. So you will have 125 rupees for the first year. Assume there is a loss of 4% in the second year. So you will end up with 120 rupees. So CAGR would be around 9.5%. So when you are investing in a mutual fund, you need to see the CAGR for the last 5 years. If there is continuous loss, then CAGR will go negative. So assume there are 10 mutual funds. First mutual fund says CAGR for the last 5 years is 10%. Second mutual fund says CAGR for the last 5 years is 12%. It goes on and say the 10th mutual fund says CAGR for the last 5 years is 15%. So you now know the higher is the better. So you will choose the CAGR with 15%. Next, about the expense ratio. So you know the mutual funds. How are these mutual funds managed? Asset management companies. Asset management companies like HDFC, AMC, Aditya Birla AMC, Axis AMC, and many other AMCs, they will manage the mutual funds. They'll have many mutual funds and they charge fees for managing these funds. Say example, you invest 100 rupees and 1% is the expense ratio. So it means they'll take 1 rupee from that 100. So the expense ratios can be 1%, 2%, and you'll have to see them and also see the CAGR before investing in mutual fund. Now, we'll move on to the next slide. Why prefer mutual fund? I'll explain this with an example. See, you invest 2 lakh and buy a stock. The promoter says it's a profit-making company with 50% profit, but in real it's a loss-making company. So you would end up in a loss with 50,000 or 1 lakh rupees. But this is not the same with mutual fund because it contains a list of stocks. Say you have 20 shares in it. Not all shares will go down and every share belong to a different company. Even if one share goes down, the other companies gets it will average them out and it won't result in much loss. So this comes in diversification. So that is, since there are a lot of stocks, it gets diversified and a return of one stock will not affect the entire portfolio returns. It will impact, but it won't impact the entire portfolio returns or the mutual funds returns drastically. So this is the first reason, and the second reason is it's less expensive to invest. Say example, you want to buy a HDFC Life share, but the HDFC Life share price itself is 670 rupees and you have only 500 rupees. You can still buy it from mutual fund as the investment starts from 500 rupees. So if there is one mutual fund and it has 20 shares in it, you'll have HDFC share as one there and you can buy it from there. That is the advantage. There are other concepts like equity mutual funds, SIP, and advantages of SIP, which we'll cover in the next sessions. Thank you.